Welcome back to the Behind the Well show. Roger Abel back with Elias Randall. Going to bring you a good show today. Going to talk about the hot topics. I think first thing on everybody's mind is government shutdown. How does it affect things? And we'll talk a little bit about the job market. And I think the third thing that people are really thinking about right now, we're starting to hear more predictions of, is that the market's overheated. I want to talk about a few of those things today and give you guys some confidence as to how to make decisions going forward. With that said, Elias, how do you feel about the government shutdown?
Okay. Happened again.
The market doesn't care.
No, market doesn't care. When was the last one? Was in 2018?
18 or 19.
Yeah, going into 2019.
2019.
So
2019.
it's kind of nice that we've already been through this. Like everyone kind of remembers the last one, and all the essential services continue to operate and they continue to fund so the government can keep going. But I'm assuming it's going to be a non-event once it's all said and done. Eventful non-event.
I think that what people may be concerned about is if the government shuts down, what happens to those workers who are forced to work and not getting paid?
They get back pay.
Yeah, they get back pay. They're furloughed. They're going to get paid. Everything's going to shake itself out. This isn't uncommon. The media might make you think it's uncommon. The government shut down 21
times.
There you go, 21
Since
times.
1976.
So, I mean, it's like every other year on average, right? Every 3 years. I mean, it's not uncommon. I wouldn't get too spun out about this. Historically, the market, the last time this happened, the market was up 3.1% during those 16 days. If I look at a historical chart, it's kind of a mixed bag, but most of the losses during government shutdowns came in the 70s. Since then, there's been about a dozen times it's shut down and only 2 times it's been negative. So once again, don't let the market shut down in any way whatsoever determine your investing strategy. There's really not a whole lot of correlation between the market shutdown and portfolios. One thing that could change that, if for some reason, we were facing a debt default, that's a different animal, but we're a long way from that situation right now.
Yeah, the government shutting down does not mean they're defaulting on their liabilities, which would be a much worse situation.
One thing that doesn't happen, though, during times of government shutdown is the economic data is not reported. There's actually a jobs report coming out Friday. Well, I guess when this hits, this will have already been out. But we all know the labor market's weakening, whether we're seeing a decline in jobs or individuals are just feeling stuck. When we were preparing for this podcast, I was thinking back to 2021 when we were doing the same thing, but the talk was how everybody is just leaving their job to take a new job and get a 20% pay raise. It was almost like you just can't hire people fast enough, can't get enough workers, pay them whatever they want. And those days apparently are over.
That was the Great Resignation, as it was called back then.
I was trying to figure out the term for that. And everybody was the FIRE movement was big too back then. Financial independence, retire early. I haven't heard anything about that the last couple of years.
FIRE's not popular still? I'm sure it still is. Maybe not as much content about it now as there was back then. I recently heard someone describe this current job market and economy as a no hire, no fire environment. I tend to agree with that for a few reasons. Well, if you compare and contrast to the Great Resignation, there's not much hiring going on. There's also a shortage of labor. Just in almost, I don't know an industry that you talk to business owners, people in industry, I don't know a single one where someone would say, oh, we have plenty of workers that are all qualified to be here and do this type of work. Everyone has a shortage, is fighting through that. So companies are not letting people go, even if their skills are fog up a mirror and show up every day. They kind of have to keep everyone around. So really, this environment is not a lot of hiring, not a lot of firing, and then workers, from one of these articles, people are starting to feel stuck in their job. So times have changed.
Becoming a employer market is what you're telling me?
I don't know. See, I don't even know how to define it. Is it really? Because you can't even fire people now.
Well,
You can't backfill.
let me ask you a
You
question.
can't go find workers, so you can't let anyone go.
I don't know if that's true. If you remember, about 2 years ago, we were looking to hire a junior advisor.
Okay.
Year and a half ago. We didn't have any qualified candidates come in. But the last job opening we had in June, we had it filled in 3 days. And we didn't even have to put out a resume. Didn't even have to do a job search. Because the individual was at another place and was just waiting to leave. To your point, people are staying in those jobs. Doesn't mean they don't want to leave. They're just waiting for the right opportunity. I feel like it's like it was the easiest hire we've ever done.
I get. So what are you getting at that?
I think it's an employer's market.
Because when you do have an opportunity, it should be easier to find.
There's a backlog of people that have been waiting to move.
Waiting to strike at something.
They haven't just left. They've been stuck at that job for 1, 2, 3, 4 years. They're like, all right, I got to get out of here. But there's not a lot open because, like you said, we're not searching. We're not searching to employ anybody right now.
Not right now.
But I think when
we would be had we not hired someone.
Right, but we had someone hired in 3 days. So I just think that's really shifting. Here's the other question I'll lay out there that I think will potentially happen. If your barrier to entry is fog a mirror, which is what you stated, you can fog a mirror, you can work here. Doesn't that lend itself to hiring younger and developing talent versus trying to find it? Because in 2021, it was all about finding existing talent. And we've watched the reports of college graduates who can't find jobs or being underhired. Well, at some point, if an employer doesn't want to pay for experience or can't find the experience, doesn't it lend itself towards hiring a college graduate and developing it?
It does. I don't know how that's going to work out for everyone.
Well, I can tell, like our industry, we just don't have that much time that we want to invest at our company in spending 2 years getting somebody up to speed.
So there's a lot of companies that are like that.
I think smaller companies are less apt to hire, probably is industry specific. But in our industry, there's a lot of technicalities. There's a lot of jargon and words that people have never heard of, don't understand how an IRA or Roth IRA or what a custodian is. So it's a little harder for somebody to grasp that very, very quickly. You'd be proficient enough to add a lot of value to your company. So we would overpay for that, for someone who can do that, versus hiring a college graduate for certain jobs here. You know, we were fortunate we got our marketing person right out of college. That doesn't have a lot to do with our specific industry, though. Now I'm making you ponder whether it increases the hiring of young people. Are job fairs still a thing at colleges? Do you know?
Yes, job fairs are still a thing. It probably is a good opportunity for younger workers to pursue careers. I mean, because just in general, wages have cooled, so people with experience and skills can't really go out and demand the type of salary they could a few years ago. Similar salary, but it hasn't increased like it did back then. There's probably a fair number of people. There's enough uncertainty with the job market that There's a term in here from a consulting firm, Corn Ferry. People are job hugging, fear of the unknown. So they're just sticking with a job. So that probably does lend itself to younger people being able to get into the workforce and be developed. They're going to have to find a good situation. As you just mentioned, there's a lot of companies that don't necessarily want to invest in developing people when they're young. They'd rather hire an already skilled, experienced worker, which maybe that means it's more of a
employer market.
But if they don't want to develop people,
yeah, I mean,
how is that?
Well,
it's almost like a stalemate.
They might be forced to.
The employers?
Yeah, they might be forced to do it because of, one, the person doesn't want to leave their job. They don't want to leave because of uncertainty. Maybe the employer doesn't want to pay what it's going to take to get them, which then lends itself to developing the talent, even though they may not want to do it.
Yeah, if I was going to speculate on something, I would say companies that are going to take a little bit of risk and invest in the new labor force or younger people, it'll probably pay off over time.
Okay, here's a question for you. Basically, there's just a lot of uncertainty in the world, right? In general, like there's more uncertainty now than there was 12 months ago. Would you agree? In general,
there's always uncertainty.
It's a higher level. You got a trade war, you have tariffs, all this talk about inflation that's not here. People aren't leaving their jobs. There's likely not going to be, wage inflation, right? With this article we're referring to. Is all of it intentional? To not have inflation? I mean, when there is uncertainty, what happens? People don't do anything. I used that analogy back in April. You could have went around to a lot of different business owners and just asked the question on April 20th, are you going to invest in your business this year? And the answer overwhelmingly would have been, I don't know. I'm going to wait and see what happens. And that's not how it was a year ago or 2 years ago or 3 years ago or 7 or 8. There's just been a lot of uncertainty sown in the world economy. And I think you used a good analogy. It's at a stalemate. And while all the uncertainty's there, guess what the market keeps doing?
Keeps grinding higher.
Keeps grinding higher. You're up 14% on the S&P roughly year to date. I just saw FS Insight, Tom Lee's company, supportive to 7,000. Probabilities suggest 7,000 year end on the S&P 500, which is another 5%. All at the same time.
Sounds good to me.
All at the same time. What are people calling for again?
Corrections.
Recessions. Here's the words I've heard. Recession, market melt up, correction. Leon Cooperman was featured on CNBC talking about how we've reached a stage of a bull market that Warren Buffett warned about.
I don't necessarily.
But we're back to predicting.
Yeah, so, and maybe he's right that it's the stage of a bull market that Warren Buffett warned about. This is also something Warren Buffett said in 1999. So one, our economy is different than it was than in 1999. The market is different too. I think most people would agree. If you look at PE, price to earnings, sometimes people like to look at that as some sort of historical indicator. Well, we've been supporting a higher price to earnings for quite a long time now than what's historically normal. So now is the market used to that? And is that something that can be supported?
Likely. And you know what, though? Here's what people aren't, when they talk about price to earnings ratio, historically, what is it, 16, 17-ish? Yes. We've been running about 21, right? Somewhere in there? Well, here's what's different. We've had 2 decades of 0% interest rates. So, of course, people are going to be more willing to invest their money in growth companies than they are in debt. In the 70s and 80s, debt was 12, 13, 14, 15, 12, 13, 14% interest. Well, of course, people are going to buy that over the stock market, which inherently lowers the price to earnings ratio, makes those companies less valuable. So it's almost an unfair way to talk about a historical number that is drastically skewed in one direction versus today. Like, okay, what's the last 20 years? That really should be the benchmark, not this 40-year historical average.
Yeah, 15. Well, yeah, 10 to 20-year periods would give you a better snapshot of how we're operating now.
No one had a computer in their house in 1970. Like, come on.
Correct. So
Things
it's
have
hard.
changed.
Yeah, that's almost unfair to compare. And when this Leon Cooperman is talking about this famous Buffett indicator, I also don't agree with how he's saying the environment. I don't feel like we're in like a end of 2021 situation where everything is going up and going up fast. I think there's enough uncertainty. And I think the other thing, the sentiment, I just don't think it's like that same 2021 sentiment that, oh, buy and hold, stocks go up forever.
When it comes to Warren Buffett's indicator, there's two parts of it. When valuations are stretched, and there's also irrational exuberance. I don't think there's irrational exuberance yet.
That's the word I was looking for. I don't feel the sentiment is not that right now.
And I think part of it is because investors are divided by political lines right now. Jonas came in my office yesterday and has a client that literally thinks the stock market has lost money year to date, but his portfolio's up 11-ish% because of their political views. And that doesn't mean it's good or bad, but this is the first time in my 22 plus years of doing this that I ever remember people this partisan about investing money and what's actually happening in the stock market. The reality is, everybody listening, regardless of political affiliation, the stock market is up this year a lot.
I remember in the spring, we talked about on our different programs, whether it's radio or this program, this is going to be a year because of what's happening in April, that the market will be positive by the end of the year, and there will be investors that think the market's down.
100%.
They remember this one big event, gets stuck in their mind, and what has happened since April? Nice rally. Really?
It's up 40%-ish. Like
Since
Leon
then.
Cooperman quotes in this article, this is a unprecedented rally. Well, yeah, the market went down 19.8% in the matter of like 20 days. That is too. But look at, if we just remove these small little micro events that are happening, year to date, you're up 14%. I had an individual client in the other day, and they were talking about how they used to check their account every day. Now they do like once a month. And I said, you should try quarterly. They go, really? I go, well, let's lay out what would have happened this year. You'd have checked your account at the end of March, and you'd have been up a little bit, a couple of percent. You would have checked your account the end of June, and you'd have been up about 8 or 9%. And you'd be checking your account at the end of September, and now you'd be up 11 or 12%. But guess what you never saw? You didn't see a 19.8% decline and a 40% rally. Like, all of this is removed from your decision-making. And honestly, isn't life just a little bit better that way? I mean, really.
I had a retired client tell me this summer, he looks at his account once or twice a year. A lot of years only once, and it's when we're meeting. But this summer, he called me and said, I logged in, checked out my stuff, looks good. But then he goes, I kind of looked at the graph of April just out of curiosity. And then he said, I'm glad I'm not a looker. That would have bothered me.
Think about that.
Here's how he has solved that as an investor for himself. He doesn't log in and look at his account.
We have said,
and is that too simple of a strategy for some people?
We have said for so long that the ability for individuals to log in, check their account, and make a knee-jerk reaction is harmful and detrimental to their financial health. I actually had this discussion with, I don't remember who I was talking about it with, but we were talking about how the average investor just massively underperforms the general market, but why land investors do as well as the market or better.
They hold. They don't. It's hard to sell.
They don't have one, they like their investment.
It's a lot more tangible.
They like it. I mean, if you buy land, we're in Iowa primarily, but it doesn't matter where you are. If you went out and bought 50 or 100 or 500 acres, you bought it because you like it. You like that investment. So inherently, when the value goes down, which you won't even know it went down because it's not priced every day, you're not going to be like, man, I got to go make a move. The second thing is it costs, there's a percentage cost to sell it. If individuals had to pay 5% to sell their investment, would they make the changes they make? No way. But what's it cost to sell any type of real estate? 5, 6%. I mean, most places 5 or 6, 5 to 7%. So that's why people don't make knee-jerk reactions. And number two, it takes time to sell. You can't hit a button.
So I have one other comment on this Leon Cooperman article and how he's bothered by excessive valuations and using this Buffett indicator to say the market's overvalued. So here's a couple other things that are going on. It's just something to think about. There are still trillions of dollars in money market accounts. So I went to a presentation on this last week. What has happened on every the last 4 and 5 years? What has happened during corrections?
By the dip.
Investors come in and buy. So even if you can make a very good argument that, and I'm sure you could make a great argument that we should have a 5 to 7% correction. Probably be reasonable, right? With where valuations and earnings and blah, blah, blah. If that happens, all the money in the money market that is now getting less yield to be there, right? When people had their money in those type of funds and we're clipping away 5%, 5% is how we've seen that's the risk-free rate of return that people will pile in at.
It's a psychological number people really like.
Looks better than 4. Looks a lot better than a 3.
It's going to 3. But I think that's a good point.
Yeah, as that yield comes down, right? Well, you can't get what you want to get on risk-free assets. If we had a correction, where's that money going to go? People aren't going to leave it in the money market and make 3%. They're going to buy into the equity markets.
I was sitting with a family yesterday. Their money market's down to 3.05%. Their question, is it worth leaving it here now? I mean, that was their fair question.
No, you're not making enough over inflation.
You're making right at inflation. And I think that's the thing that people need to recognize. Whatever the bank is paying you, for the most part, unless if you locked in like a 3-year CD at 4.5% or 5%, that's one thing. But current cash rates today are incrementally lower or higher than inflation depending upon the number, but it's not meaningfully higher most of the time. It's just not what it is, because what happens? The Fed lowers overnight lending rates, brings that rate down. And that is a good point. As soon as, I shouldn't say as soon, but when and if rates do come down further, there will be much more incentive to get back into the stock market. We had more people not go to cash, but allocate more of their money to CDs, money markets, safe cash places at 5% than I remember in a long time. And it wasn't because we were timing the market or they thought that, just hey, look, I'd like to have some of this at 5-ish%. Those days are over. I don't have anybody calling up off the street anymore saying, hey, what's the CD rates? 2 years ago, everybody's like, hey, I heard we can get 5.5% or whatever the number was in a CD. That's not happening today because those are gone.
I think the other thing with investors, which I won't be surprised if we have this conversation again, this market melt up idea and all this. I just don't think it's where we're at now. I think the market's going to have to go up higher to get to irrational exuberance.
Well, let's end the show with one quick listener question. They didn't give us her name, just said, I'm 57. I have a few different IRAs that I have been looking at consolidating. At the same time, I have short-term expenses coming in. A friend mentioned the 60-day rule that would let me take the money out, put it back before the deadline. Is this a good idea, or am I setting myself up for problems? The key here, just so you know, they're IRAs, not a 401k, because it would be different. If this was a 401k, and I hope the listener knows the difference, if you are going to do this 60-day rule from a 401k, there would be mandatory tax withholding. And that would be bad because when you put the money back in, you have to put the full amount. So let's just talk about the 60-day rule a little bit. It is a way to do what's called an indirect rollover. And instead of sending the money from custodian to custodian, it is where the check goes to you, you cash it, and then you have to redeposit the entire amount within 60 days to avoid taxes and penalties. If it's a 401k, mandatory tax withholding, you have to redeposit the tax. I highly recommend against doing this. You are playing with fire. What are your thoughts, Elias?
Very simply, that if you are considering using money from your IRA to cover short-term expenses and you're questioning whether you can hit this 60-day timeline or not, you're setting yourself up for problems. Your short-term expenses should be covered by cash. So just the fact that you would ask this question makes me think that not going to work. How's it going to work?
And if you don't pay it back, it's the same as just taking a distribution. So,
yes.
Listener.
So they should be prepared to take a distribution if they're going to attempt to do this.
So we would agree 100% this is a bad idea. Let's not do this. I don't think it's a good idea to do a 60-day rollover. Do a rollover, transfer the correct way, custodian to custodian, and make sure it's done correctly. It's part of the reason you work with a financial professional. People get confused on this. I've seen this happen more than once. And guess when they call a financial advisor?
Day 62.
Day 62. How do I fix it? It's probably happened about 6
You're
times
not
in my
going
career.
to fix it.
They don't work with me. It's like we get a random person that calls the office. Hey, I did this. How do I fix it? I remember I had a guy call one time.
Good luck.
I had a guy call one time. He's getting divorced. And they did the divorce themselves, didn't use attorneys, split the assets. And, he thought he was really, really smart. He just gave the money from the 401k to his ex-wife. Day 64 came. What do? I said, you're paying tax and penalty. It's over. You should have had a professional, should have had people help you do this. But,
how did he take that answer?
He didn't really have a choice. He wanted me to help him. I'm like, there's nothing I can help you do. And you're not a customer. You just called him off the street. Like, I don't know what you want me to do here. You've refused professional advice in every aspect of your life. He's an engineer, so not that I'm bagging on engineers, but his entire life he refused professional advice, but this is the time he wants it.
Good job.
I'm more questioning what the ex-wife thought about it.
She probably laughed.
What if they got an attorney involved?
She probably laughed. What if she got all this money and then he had to pay all the tax? She probably thought it was funny.
I'm sure I don't know how there's no reason to speculate. With that said, I want to thank everybody for tuning into the show today. If you have any questions like the listener did here, please email us. We've been pretty well received. We'll try to answer it on the show. With that said, follow us on Facebook, YouTube, X. Please like and subscribe the channel. We'd appreciate that. Elias, any closing remarks?
Thank you for listening. Have a good day.
Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. The opinions voiced in this show are for general information purposes only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial or tax advisor prior to investing. Premier Investments and Wealth Management and LPL Financial do not provide tax advice. Please consult your tax professional. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. There's no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. Rebalancing a portfolio may cause investors to incur tax liabilities and/or transaction costs, and does not assure profit or protect against loss. All performance referenced is historical and is not a guarantee of future results. All indices are unmanaged and cannot be invested into directly. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risks, including possible loss of principal. Dollar cost averaging involves continuous investment in securities regardless of fluctuations in price levels. Investors should consider their ability to continue purchasing through periods of low price levels. Such a plan does not assure a profit and does not protect against loss in declining markets. Consult your tax professional about eligibility to Roth and traditional IRA contributions. Contributions and earnings in a Roth IRA can be withdrawn without paying taxes and penalties if the account owner is at least 59.5 and has held their Roth IRA for at least 5 years. A plan participant leaving an employer typically has 4 options and may engage in a combination of these options, each choice offering advantages and disadvantages. Those options include leave the money in their former employer's plan if permitted, roll over the assets to their new employer's plan if one is available and rollovers are permitted, roll over to an IRA, or cash out the account value.